Welcome back to the Modern Investing channel. Today we are analyzing semiconductor stocks. We will value them with a discounted cash flow model running 1000 Monte Carlo simulations, and then we will determine which is the best risk to reward investment. Let's dive into that. Semiconductors is a must-have exposure in everyone's portfolio, in my opinion. The world is getting more and more connected, and microchips are being integrated in every aspect of our life. Between the electrification of everything and new frontiers like autonomous driving and artificial intelligence, it is safe to assume that this industry is set to proliferate in the years to come. It has been estimated that semiconductors market as a whole is supposed to grow at an 8+% compounded annualized growth rate through 2028. But the big question investors ask themselves is, can we find value in this growing market? During the pandemic, semiconductors received an unprecedented demand for electronic devices of all kinds, from car manufacturing to consumer electronics, data centers, etc. All these coupled with supply chain issues that choked supply and increased prices. This graph shows the semiconductor stock index, and you can really see how much these semiconductor stocks benefited from the higher prices and high demand in the last couple of years. However, these stocks fell sharply in the last few months, together with the broader market, raising the question on whether now it's a good time to buy the dip. To answer this question, we will value 5 key companies that are arguably the leaders in the semiconductor sector and determine their risk to reward outlook. The first is Intel, and I made a dedicated video on that if you are interested. Have a look into that. Intel is a behemoth in the space. It designs, manufactures chips, and its main business is its PC division, where it produces strong cash flows. Intel has been though through a lot of drama lately. It has been mismanaged for years, where it has lost its competitive advantage it once enjoyed. It now got a new CEO and is set to spend tens of billions of dollars to regain the number one status. The second company is AMD, and AMD has been an incredible success story, which stole a lot of market share from Intel and became a contender as one of the best semiconductor PC maker. AMD outsources its manufacturing. It designs CPUs, GPUs, chipsets, and similar computing products. The third company is Nvidia, which provides graphics and networking solutions. Because of its strong focus on graphic processing, there is a ton of expectations for the future of Nvidia in video recognition for self-driving cars and virtual worlds, as well as gaming in general. It is worth mentioning that there is no hardware manufacturing facility at Nvidia. Their chips are produced by third-party hardware manufacturers. Qualcomm is another company we analyze. They also outsource manufacturing to third parties, as they are leaders in technologies for the wireless industry. So they develop and supply 3G, 4G, 5Gs, and other technologies for using wireless voice and data communications and global positioning system products. They own, for example, the Snapdragon chips that end up in the high-end Android phones. Also, a big portion of their business is granting licenses or providing rights to use a portion of its intellectual property portfolio, which includes various patent rights useful in the manufacture and sale of wireless products. Taiwan Semiconductor Manufacturing Company, as the name implies, are fully fledged in the manufacturing side, where they produce, package and tests and sell integrated circuits and other semiconductor devices for companies like Qualcomm, Nvidia, and AMD. Finally, Skyworks Solutions, which sells semiconductor products for use in radio frequencies and mobile communication systems. Skyworks uses a hybrid manufacturing model, vertically integrating the core production while entering in strategic partnership for certain technologies. In a sec, we will move to value these companies, where we will model future free cash flows growth and all that. However, before we go into that, let's have a look at these companies' key financial performance metrics in the last 10 years. Revenues grew for all companies over the last 10 years, with Nvidia having the lead with an impressive 23% compounded growth rate. To note though that in the past year, all companies apart from Intel got a massive bump in revenues. If we look at gross margins and take the averages over the years, we can see that there are very different pictures. Intel has had high gross margins at 60% on average. However, they have been declining over the years to 55% of the last year. AMD has lower margins, but they sat comfortably above 40% in the last 3 years, with a clear trend of improvement. Nvidia has also improved gross margins with time, printing 60% or more in the last 5 years. Qualcomm has had ups and downs pretty regularly, with high 50s gross margins. Taiwan Semiconductor has stable gross margins in the high 40s, as well as Skyworks. Looking at net income, Intel and Taiwan Semiconductor are the behemoth with about 20 billion in the last year, whereas the others are not even half that amount. The growth rates matter though, and there Nvidia has printed an astonishing 37% annualized growth in the last 10 years. Skyworks has also done very well with 25% per year. Worth mentioning is that AMD is accelerating profits massively. It has had negative net income until 2017, and from 2018 to 2021, it has 10x net income, so it is certainly on a very exciting trajectory. Operating cash flows pretty much follows the same pattern as net income, so let's jump to free cash flow, which is arguably the most important metric for value investors. We can see that all companies apart from Intel are accelerating their free cash flows at double digits per year, where AMD turned positive in 2019. Looking at the figure from last year though, AMD and Skyworks are the small fish as compared to the others. If we look at the free cash flow margins, Qualcomm has the lead with 31% on average and 42% in the last year. We can see that Intel has a declining margin in this last year to 12% as compared to its long-term average of 19%. And we can also see that AMD is accelerating at a rapid pace its margins in the last few years. Overall, what all these numbers tell me is that AMD, Nvidia, TSM, and Skyworks are fast-growing guys, where AMD and Nvidia are the fastest of the pack. Qualcomm is the stable one with cyclical changes over the year, apart from last year where it performed amazingly. Intel instead is the one in decline, and that is why its new CEO is so much focused on turning around the business. We will use these growth numbers and margins in the company valuations because obviously growth is only one part of the story, but valuations also matter. Let's dive into that. I will show you one example with Qualcomm in how I calculated the undervalued potential of the stock. Here on top, we have the input values and valuations. For the next 2 years, I took analyst revenue estimates in red. For year 3 to 6, I predict that Qualcomm will grow between 6%, which is the historical growth rate, and 8.6%, which is the long-term predicted growth rate for the semiconductor industry. In years 6 to 10 instead, I set the revenue growth rate to be at 8.6%, which will reflect the broader market. In this row here, you can see the predicted revenues for the years to come. The free cash flows in these rows are calculated by multiplying the revenue for the free cash flow margin, which I set it in these cells here to be between 27 and 31% based on Qualcomm track record. And the discounted cash flows are in this row. Here we have discounted them by 8%, which is a discount factor that I kept constant for all business I analyzed today in order to make a fair comparison among them. I calculated two types of terminal values at year 10 based on the perpetual growth model and terminal multiple. For the perpetual growth model, I assume a 2% perpetual growth after year 10. And for the terminal multiple, I assumed a multiple between 11 and 17 for Qualcomm, which is fair for a medium growth stock. For the record, the free cash flow multiple today is 13 for Qualcomm. Comparing the current enterprise value with the estimated future discounted cash flows and the average of the two terminal multiples, we get the business today is on average 60% plus undervalued as compared to its intrinsic value. This is calculated with 1000 simulations, taking the input data ranges that I gave it and you can see in this graph over here the distribution of the results. It's important to notice that even the 10% most bearish simulations of the 1000 still gave us around 50% undervalued, meaning that I can have a confident assumption that the business is indeed undervalued at current price, and in the best case, the business is 70% plus undervalued. In this table, I summarized the input values I used for all the valuation of the businesses, so feel free to stop the video and check them out individually if you're interested. I would like to draw your attention here on the last two columns, where I reported the mean result from the simulations, calculating how undervalued the businesses are as compared to the current price. In this row, it is calculated with the same 8% discount rate for all businesses, in order to have a straight comparison. And in this row, I calculated it with the weighted average cost of capital as the discounted factor, which differs from business to business. What I would like to see is businesses that are undervalued, regardless of the discount factor employed. We can see that Qualcomm and Skyworks are significantly undervalued as compared to their current price, offering a significant upside for the investment. Intel is a close second, offering more than 20% upside and even more when the discount rated is the weighted average cost of capital. AMD is a mixed bag instead. It looks very attractive when you use an 8% discount rate, but it's overvalued when you use the weighted average cost of capital. TSM is fairly valued at current price, and Nvidia is overvalued. So what I take out of this comparison is that the best opportunities from a value perspective lay with Skyworks, Qualcomm, and Intel. AMD is a mixed bag, TSM is fairly valued, and Nvidia is fairly valued at best or overvalued. If you are interested in the 1000 distributions of the results I just showed you, you can pause the video here and examine it in more details. You can see where the average results of the simulation land and the distribution between the best case and worst case scenario in the calculations. For example, for AMD, these simulations with the 8% discount rate show that the mean result is that AMD is about 40% undervalued as compared to what is trading at now. And on top of that, there is a small percent probability that the percentage undervalued at current price is as big as 85% or more. And also there is a small chance on this side of the graph that AMD is overvalued today. I encourage you to examine this graph one by one to appreciate the differences in the various businesses in terms of mean return potential, but also the uncertainty of those valuations. In conclusion, I think it's a good idea to expose my portfolio to semiconductor stocks because microchips are the present and the future. And as a long-term investor, I want to have exposure to sectors with strong secular tailwinds. However, valuations matter, and my calculations suggest that Qualcomm, Skyworks, and Intel are the most attractive investments among the ones I analyzed. So I will give the crown to the three of them, and I'm planning to build a basket of these three stocks for exposure to the semiconductor industry in my portfolio. I will keep my valuations updated as new earning reports come in, so subscribe to the channel if you want to keep up to date. As a disclaimer, I already own some shares of Intel and Qualcomm. Don't forget to click the like if you enjoyed the video, and see you in the next one. Before we go, I must remind you that I'm not a financial advisor and this content is not financial advice. It's just my opinion and you should do your own due diligence before investing in any product. Have a great day.